Home prices in some countries just hit all-time highs. In others, they're crashing. The data reveals a massive global divide. In 2025, real estate markets around the world are moving in completely opposite directions. While home prices in Germany are down nearly 4%, properties in Dubai have surged over 18% in a single year. The US sits somewhere in the middle, but that national average hides an extraordinary divergence between cities. Some American metros are outpacing every developed market on Earth. Others are quietly correcting. In this video, we map the global data, rank the fastest and slowest growing markets, pinpoint where the US fits in, and break down exactly what's driving the divergence. Whether you're deciding where to invest, where to buy your home, or simply trying to understand what's happening to real estate worldwide, this data will change how you think about the market. Let's start with the 30,000-foot view. Across 40 major economies tracked by the Bank for International Settlements and Knight Frank's Global House Price Index, the average global home price growth in 2024 was 4.2%. But that number is almost meaningless once you look underneath it. Of the 40 markets tracked, 11 recorded negative price growth, meaning home values actually fell. 14 markets grew between 0 and 5%. 9 markets grew between 5 and 10%. And 6 markets surged above 10%. What we're seeing is the most divergent global real estate market since the 2008 financial crisis. High interest rates crushed affordability in indebted markets like Germany, Sweden, and New Zealand. But markets with strong foreign demand, supply constraints, or currency advantages are booming. The single most important variable? How aggressively each country raised interest rates, and how housing supply responded. Let's start at the bottom. The steepest declines are concentrated in Northern Europe and a handful of Asia-Pacific markets. Germany leads the decliners at negative 3.8%. German house prices surged 60% during the pandemic, fueled by ultra-low rates and foreign investment, and are now giving back those gains as the European Central Bank raised rates aggressively. Sweden is down 5.2%. Sweden's mortgage market is uniquely exposed because most Swedish mortgages are variable rate. When rates rose, monthly payments spiked immediately. Homeowners who stretched to buy at peak prices are now underwater. New Zealand fell 3.5%. The Reserve Bank of New Zealand hiked to 5.5%, the most aggressive tightening cycle in decades. South Korea dropped 4.1%, particularly in Seoul, after government measures to cool the market combined with rate hikes hit demand. The lesson from these markets is consistent. Countries that relied on variable rate mortgages and saw the steepest rate rises have suffered the sharpest corrections. Not falling, but barely moving. Several major markets are in a holding pattern. Japan's national average shows just 1.2% growth, but that masks a dramatic split. Tokyo condos are up 8%, driven by foreign investment and limited land supply in the city center. Rural Japan remains essentially flat or slightly negative, continuing a decades-long demographic decline. Canada grew just 1.8% nationally. Toronto and Vancouver, the two most expensive markets, are nearly flat as affordability has reached a breaking point. Younger buyers simply cannot qualify for mortgages at current prices and rates. The UK recorded 2.1% growth. London is essentially flat at 1.3%. But the north of England and Scotland show 4 to 5% growth as remote work continues reshaping where people want to live. The United States nationally grew 4.1%, above this slow growth tier, but well below the global hotspots we're about to cover. Slow growth isn't collapse, but for investors, it means capital is likely better deployed elsewhere. The United States deserves its own analysis because no country on Earth has more internal market divergence. That 4.1% national average spans a range from negative 1.2% in San Francisco to positive 9.2% in Miami. Let's rank the key U.S. metros. San Francisco is the only major U.S. market recording negative growth, down 1.2%, as tech layoffs and remote work exodus continue. Austin grew just 2.3%, a significant cooling from the pandemic-era surge of 40% over 2 years. New York and Los Angeles are growing modestly at 3.2% and 2.8% respectively, above the national average. Phoenix at 6.7%, driven by continued population migration from California. Columbus, Ohio at 6.4%, one of the most consistent performers, with strong job growth and relative affordability. Charlotte, North Carolina at 8.1%. The Southeast continues to attract corporate relocations and remote workers. Tampa at 7.3% and Nashville at 4.8% round out the strong performers. Miami leads all major U.S. metros at 9.2%. International capital from Latin America and Europe has made it effectively a global real estate market. Move up the growth curve and you find a group of stable, developed markets delivering solid gains. Spain leads European developed markets at 7.4%. The Spanish coast, particularly the Costa Brava, Mallorca, and Marbella, is seeing intense demand from Northern European retirees and remote workers. Barcelona and Madrid are both above 7%. Australia grew 6.8% nationally, with Sydney and Melbourne driving the averages. Despite among the highest household debt ratios in the world, Australian home prices have proven resilient. A supply crisis driven by planning restrictions and surging immigration is overwhelming any demand destruction from rate hikes. Greece continues its remarkable recovery at 9.8%. Starting from a base crushed by the 2010 to 2015 debt crisis, Greek properties in Athens and the islands are still cheap by European standards, but rising rapidly as tourism revenue, digital nomads, and the Golden Visa program attract foreign buyers. The Netherlands at 6.1% and France at 5.2% round out the moderate gainers, both benefiting from chronic supply shortages in their major cities. Now for the highest growth markets on Earth, and the reasons behind the surge. The UAE, led by Dubai, is the global leader at 18.3% growth. Dubai's combination of zero income tax, world-class infrastructure, a stable currency pegged to the US dollar, and a government actively courting foreign investors has created a perfect storm. Russian, Indian, Chinese, and European capital is flooding in. Property transaction volumes hit an all-time record in 2024. Georgia, the country, not the US state, grew 15.1%. Tbilisi has seen an extraordinary influx of Russian and Ukrainian capital following the 2022 war, combined with a new wave of European digital nomads attracted by the 1% flat income tax and visa-free access for most nationalities. Vietnam surged 12.4%, with Ho Chi Minh City leading. Rapid urbanization, a young population, rising middle-class incomes, and significant infrastructure investment are driving structural demand that shows no sign of slowing. Portugal hit 11.2% despite ending the Golden Visa program for residential properties. Demand from expats, remote workers, and retirees, particularly from the US, UK, and Brazil, has outpaced any policy-driven cooling. Turkey's numbers require an asterisk. Nominal growth exceeds 20%, but in real inflation-adjusted terms, growth is approximately 5%. The lira's collapse means foreign buyers are getting Turkish properties at a steep discount in dollar terms, which is itself driving foreign demand and pushing local prices higher in a self-reinforcing cycle. Understanding the pattern behind these numbers reveals the key variables that determine where markets go next. Variable rate exposure is the single most powerful predictor of decline. Countries where most mortgages are variable rate, Sweden, Norway, South Korea, New Zealand, got hit hardest by rate hikes because monthly payments rose immediately for existing homeowners, killing demand and forcing distressed sales. Fixed-rate markets like the US, France, and the UK were partially insulated. Supply constraints trump rate hikes in desirable markets. In Dubai, Tbilisi, Miami, and coastal Spain, there is simply not enough land or permitted supply to meet demand from wealthy foreign buyers. The wealthy don't need mortgages. Foreign capital flow is increasingly dominating premium markets. Dubai, Portugal, Greece, Vietnam, and Tbilisi are all receiving capital from specific geopolitical and economic migration flows. Russians, Indians, Americans, South Americans, that have little to do with local interest rate policy. Currency dynamics create extraordinary buying opportunities in dollar terms. Turkey and Georgia are dramatically cheap for USD holders, and that cheapness itself becomes a catalyst for foreign investment that drives local prices up. Finally, demographic divergence is the slow-moving force underlying everything. Markets with growing young populations, like Vietnam and the Philippines, face structural housing shortages. Markets with aging, declining populations, like rural Japan and parts of Germany, face structural oversupply, regardless of what central banks do. So where does the data point for investors? There are three distinct opportunities, depending on your risk tolerance and time horizon. For low risk, stable growth, U.S. Sun Belt metros, Charlotte, Tampa, Phoenix, and Miami offer the best combination of rule of law, dollar-denominated returns, deep liquidity, and above-average price growth. Charlotte and Tampa in particular represent the sweet spot of affordability, job growth, and yield. For moderate risk, higher growth, Spain, Greece, and Portugal offer developed market legal frameworks with double-digit growth potential in the right submarkets. Spain's coastal properties and Athens condos are particularly compelling for the risk-adjusted return profile. For higher risk, potentially exceptional returns, Georgia and Vietnam represent the clearest cases of structural undervaluation meeting explosive demand growth. Tbilisi condos at $800 to $1,000 per square meter, compared to $8,000 in Lisbon, have significant room to run. Ho Chi Minh City is urbanizing at a pace that makes supply shortages structural, not cyclical. The markets to avoid right now: Germany, Sweden, and New Zealand still have further to fall as the full impact of rate hikes works through variable rate mortgages. San Francisco faces structural headwinds from office vacancy and population loss that are unlikely to reverse in the near term. Here's the bottom line. We are in the most divergent global real estate market in a generation. The US at 4.1% is a mid-tier performer, better than falling Europe, weaker than booming emerging markets. Within the US, you need to pick your metro carefully. Miami and Charlotte are performing like emerging markets. San Francisco is performing like Germany. Globally, the highest growth is concentrated in markets receiving significant foreign capital inflows: Dubai, Georgia, Portugal, Vietnam, and in markets with severe structural supply shortages. The data tells a consistent story. Population growth, foreign demand, and supply constraints beat interest rates every time. The cities and countries that check all three boxes are where the next decade of real estate returns will be made. If this data-driven breakdown helped you see the global real estate market differently, subscribe to Property Ranked. We run the numbers so you don't have to. Hit the bell so you never miss our next deep dive.